In a growth-constrained global economic environment, currency adjustments have become particularly important, both to a country's economic growth rate, but increasingly to the performance of its equity market. If we just look at the performance of the Nikkei over recent years, we can see the Nikkei is in gold, the yen, US dollar yen rate in red, and see quite a high and striking correlation between the two, with the Japanese equity market being one of the major outperformers, along with Europe more recently. So we're going to have a look at some of the correlations between various markets and their currencies. The first one, as we've already highlighted, is the Nikkei and the US yen rate. And we're looking at rolling 180-day correlation, so quite a high and extreme positive correlation that we just referred to, as you can see here. If we now look at the DAX and the euro, so once again a very extreme level at the moment, extreme negative correlation between the currency, which has been declining, and the performance of the equity market. Likewise, when we look at the Australian equity market, we get a very similar picture once again. Now, typically, going back certainly in 2009 through 2012, we had quite a high positive correlation between the currency and the equity market performance, and predominantly that was due to the performance of resource sector, which was not only driving the equity market but also driving the Aussie US dollar higher. Now, this is reversed now back to levels really not seen in certainly the last decade and a half, with the correlation over the last 180 days around about -0.8. So our equity market has become very much dependent on currency weakness. So our comments at the outset that in a growth-constrained global environment, any small move in a currency the wrong way, i.e. strengthening, has been a negative for perhaps growth prospects, but also for your equity market performance. We only need to look at the performance of the US equity market in recent times to get a better understanding of that trade-off. And in this chart, we're looking at once again the correlation between the S&P 500 and the US nominal major currency index over 180-day periods. That's the blue line. So extreme negative correlations here, and you can see here more recently it's come back up to being quite a strong positive relationship. So a rising US dollar is occurring at the same time as a rising US equity market. But the point of most interest here is that these periods of negative correlation, extreme negative correlation, occurred during the QE periods. So we had the US dollar, which is the red line, coming off, the equity market doing well as we came out with the first round of QE, coming out of the Great Recession. Then the second round of QE, once again US dollar coming off, equity market started to do quite well. Again, in the early part of QE3, we had the equity market, or the currency, remaining fairly low, but the equity market starting to do quite well. And the two had been increasingly positively correlated as it began to appear as though the US was able to continue to grow independent of currency strength. Now, that was fine while the currency was only rising at a very slow rate, but the pace of change or appreciation in the US dollar from the mid part of last year through to early this year has begun to cause some problems, and we're seeing the correlation between the US dollar and the market now begin to turn back down over a shorter time period. I think back to the low. So just looking at more recent developments in the US dollar and the performance of the equity markets, we just said that the correlation had turned positive over the last 180 days up to around about 0.6, 0.7. But as we know, in the last couple of months, last 2 or 3 months, we've seen a poorer performance from US equities, as the strength in the currency has not only undermined earnings but also undermined export growth in the overall economy. So if we look at the correlation over a shorter period, actually 100 days actually will go a bit lower than that. If we go back to sort of an 80-day correlation, you can see that the correlation has gone back into negative territory. So currency strength has been associated with sort of weaker equity market performance, and this is important when we look at in an Australian context at the moment, with the currency staying higher than what is desired, and certainly probably what is warranted on the basis of fundamentals, which is undermining the market here and making the transition away from the mining sector to the domestic sectors that much more difficult. So from an investment point of view, this relationship between currencies at the moment and equity market performance makes it very, very important to take into account likely currency moves. So for an Australian dollar investor at the moment, while they may be happy to be overweight those regions that have the easiest monetary policy settings, that are generating excess liquidity and are seeing signs of a turnaround in earnings and also economic growth, and I'm talking about the Japanese and European equity markets, it's very, very important to get the currency call correct as well, looking for those currencies or hedging into those currencies that are actually doing the opposite or beginning to move to a tightening phase. Now, I want to now finish off with just a couple of comments on another area of correlations of interest at the moment, and that's between equities and bonds. And I'm looking at the correlation, rolling 24-month correlation between US equity market returns and US 10-year bond returns. This goes back to about early 1900s. You can see how that correlation has changed. Now, in more recent times, and the shaded areas represent those areas where the correlation has been negative, or low to negative. So since about 2002, you've seen a fairly consistent low to negative correlation between equity markets and bond markets. The same occurred in the late 50s, early 60s, and then of course during the 1920s through to much of the 1940 period. Now, one of the things that we had a look at was what regimes have been associated with these different levels of correlation in the markets. And so what I'm going to do now is rank those. So what we're doing now is we're looking at the correlation of US equities to the US 10-year bond, rolling 24-month calculations, and we are ranking the regimes. So what it's suggesting is that ignore the first one, but high inflation regimes have been associated with the high positive correlations. These are average numbers of around about 0.26 between bonds and equities, and at the other end of the scale, those periods that have been nominated as deflationary or high deflation risk, and also NBER defined recession periods in the US have been associated with very low correlation periods. So in determining, or from an asset allocation perspective, it's very important to once again focus on what sort of regime do you foresee in the period ahead. If you're of the view that the sort of deflation, low growth type outcomes are likely to continue, then perhaps the correlation between the two asset classes will remain low and possibly also negative.